What is up, sausages? It is the Money Sausage. Today we're going to be talking about what is cryptocurrency, why people invest in it, what's the benefits of it, and kind of why people use it to trade for actual physical products. Before we get into today's video, please leave a like on the video. It would mean the world to me, and it would help boost this video to the YouTube algorithm. It takes a quarter of a second, and it would help me out a ton. With that being said, let's get right into today's video. So what is cryptocurrency? Cryptocurrency, in summary, it's a currency that is traded completely online. It is an asset that has a certain digital tag to it that is used to go from one internet wallet to another internet wallet. Now, the thing is if you want to make your crypto secure, you can put it into a hardware wallet. So imagine you send an email, right? You send an email with a JPEG of a koala to another email. That email receives that JPEG, downloads that JPEG, and now that JPEG of that koala like this is now theirs forever. Now they can take that, and although they can keep it in the server of their Gmail, they can take it off the Gmail, put it onto their computer, and save it into a file. And that's what, in relevance to cryptocurrency, is called a hardware wallet. Now I'm going to make another video about hardware wallets, how to make your crypto secure. But we just want to talk about what cryptocurrency is. So basically, cryptocurrency is a currency that is exchanged from one virtual wallet, as I said earlier, to another. Now, why would people even want to invest in cryptocurrency? Well, the original appeal of cryptocurrency it was completely decentralized. Governments couldn't track the transaction from one wallet to another, so people couldn't tell how much was being traded. So someone could be sending millions of dollars from one wallet to another, and no one would be the wiser, but those two people when it gets traded from one wallet to another. Because when you have a virtual wallet, your identity is not connected to that wallet, and it's just a set of numbers that is constantly changing in the gateways that cryptocurrency is exchanged. So it's really good in that way that it is decentralized and it is completely peer-to-peer. So if you want to pay someone for a service, instead of having to Venmo them and Venmo keeping that transaction alive and put it on your taxes, the cryptocurrency is a way of underbellying that and just going from your peer-to-peer without any outside institution regulation. Now, some crypto exchanges have started working with the IRS and have started reporting when someone gets something into their wallets, but there are many other crypto exchanges that don't allow for that to happen, that they don't work with the IRS, and it's kind of, you should report it on your IRS because obviously being able to report that kind of stuff is what you should do. It's what you should legally do, but they kind of leave it up to you if you want to report that on your IRS tax form. So in that way, it is decentralized and it's completely peer-to-peer and it's pretty secure, meaning that you have full control of your cryptocurrency from A to B. And if someone steals your cryptocurrency, it's usually your fault because you didn't put in a secure asset or a secure wallet. And so the way that the currency is tracked from A to B is it's completely tracked online. So think about it as an IP address. Your computer, when you log on, is an IP address. It's registered so the internet knows, hey, this person is logging on. This computer has a valid internet primary source that allows for them to access the internet. And that is the same way cryptocurrency works. When you exchange it from one person to another, the blockchain, which is the sequence of events that occurs to trade one asset from one wallet to another wallet, that's what's called the blockchain. To take it from here to here, that it goes across the blockchain and it pretty much takes a bus terminal down to the next wallet. But the blockchain verifies that this is an actual cryptocurrency, that this is a legitimate seed in the cryptocurrency and blockchain. And the blockchain has a set of numbers. It's a lot of numbers. It just runs on, but every single number has a meaning, and they want to make sure that that is an actual, let's talk Ethereum or Bitcoin. That's an actual Ethereum that's being traded through the blockchain. The way that cryptocurrencies hold their value is the same way that a stock holds their value. Some cryptocurrencies regulate how many of this coin were first minted when this coin was launched. Some regulate how much is minted per year, and some cryptocurrencies don't regulate at all how many of those coins exist. Now, those coins that have a set amount that were initially minted when the coin was announced, those are usually more solid in their price fluctuations. Meaning it's easier to track those, as in you're tracking it at like a stock can be tracked. And the same way, those that have the set amount that is minted every year, it's like tracking a currency and how a currency fluctuates in price. Now, those that aren't tracked or aren't regulated in how much is minted per year, those are the ones that have super volatile prices. So the meme coins and stuff like that, that is why they can shoot up to 75 cents per coin, but then plummet down to 1/millionth of a cent per coin. So those can be really, really volatile. And so in that way, cryptocurrencies hold their value like a stock. And so when you trade it from one person to another, from one wallet to another wallet, the blockchain, when it's exchanged, is saying, hey, person X is exchanging to person Y 1.5 Ethereum. So it subtracts that from one person's wallet and it puts that 1.5 Ethereum in person Y's wallet. So now person Y has 1.5 Ethereum in their wallet. What you can do is take that 1.5 Ethereum to a certain cryptocurrency exchange, which is kind of like the stock market, the stock exchange, where you're allowed to say, hey, I have 1.5 Ethereum. I want to sell this and execute this price now. Like, I want to sell this Ethereum now. Now, let's say that Ethereum is at $1,000 per Ethereum. So when you say, hey, I want to sell 1.5 Ethereum and exchange that for cold, hard cash, you go onto that exchange and you say, I'm going to execute a trade for 1.5 Ethereum. And the exchange basically says, okay, cool. In exchange for you trading that Ethereum, we're going to take 0.01 Ethereum. So you get 1.49 Ethereum total. So you get $1,490 deposited into your account in cold hard cash, which you can then transfer to your bank or cash out and put that money into your bank. Or you can take that money and buy another currency such as a Bitcoin, and you only will get, I don't know, like 0.1 Bitcoin. But that is how an exchange works. They get a little percentage of what you get when you want to exchange that money or that cryptocurrency for cash, and then you take that cash and you're able to put that into your bank account, or you're able to exchange that cash for another form of currency. So that is why exchanges work and how it works like that. So cryptocurrencies hold their value kind of like a stock, and it is regulated via the demand that has occurred on a certain cryptocurrency. And so in many ways, when cryptocurrency is at its very peak, it's because a lot of people are in the hype train. They're buying. And so that is why you will see a cryptocurrency go to absolute moon and just ride it up like a rocket. And then everyone will start selling, and then the price will immediately start collapsing and fall down. So yes, cryptocurrency can experience bubbles, and it can experience some very severe bubbles, but at the same time, it can be easy to track when the bubble is going to occur, kind of like the stock market and any other investment. However, if crypto can be extremely risky because it is very volatile, and that's why investing in meme coins and things that don't have a regulated mint amount per year or when it's established, it can cause that coin to be very, very volatile. And now that's why Ethereum and Bitcoin and other cryptocurrencies are more well trackable, and that's because it has a limitation on the amount that was minted when it was established, and it has a limitation on how much is minted per year. And that is why those cryptocurrencies are so reliable on tracking. And yes, they can still be risky, but it makes it a little bit less risky. So you have a little bit better hedge against that risk. Now, some people use cryptocurrency to money launder and not report on their taxes, which I don't recommend. Make sure that you report your cryptocurrencies to the IRS just to make sure that they know what's going on and that you're not doing anything illegal. Just make sure that you are keeping yourself legally safe and keeping yourself safe in all regards. With that being said, if you enjoyed today's video, hit that like button. If you want to see more of the Money Sausage, make sure you hit that subscribe button and that notification bell. It'd mean the world to me. And with that being said, it is the Money Sausage signing out. See ya!